Hello and welcome to Brickwork Ratings, yet another podcast series. Today we have a very eminent guest with us who generally do not need any introduction, but it will be my own pleasure to introduce him to this amazing, small session which we want to have some insights from him. He'll be talking about the, issues, challenges the pandemic has thrown at us, and also how can we move out of these. So let me take a brief moment to introduce none other than Shri N.S. Vishwanathan. He has been the Deputy Governor of RBI, Reserve Bank of India, from June 2016. Before this, he was Executive Director to RBI, and as Deputy Governor, he has been looking after various departments including banking regulation, cooperative banking regulation, non-banking regulation, deposit insurance and credit guarantee, financial stability unit, inspection department, risk monitoring department, and secretaries department as well. He has been expert in the areas including all the regulation and supervision of banks, NBFCs, cooperative banks, currency management, foreign exchange, human resources. He had a 3-year secondment to the Bank of Mauritius and also has been the head of Chennai for RBI. And it is a huge pleasure to welcome him in this session with Brickwork Ratings. Sir, brief welcome and a warm welcome to you. We are very happy and delighted to have some insights from you. So welcome to the show.
Thank you for having me. Thank you.
Yeah.
It's my pleasure.
We would start this session with understanding, how do you read the impact of COVID-19 on the banking industry as well as the Indian economy?
Yeah. I think there's been a lot of work done, a lot of publications from both RBI, the statistics have been out. So actually, in terms of what impact it has had, we already know a huge, almost 23% contraction in the quarterly GDP on year-on-year basis. The banking system would have stabbed on a huge NPA, but for some of the actions that the Reserve Bank took in advance. And of course, most importantly, once the pandemic is fully off and the banking system starts working, and some of this impact of these regulatory forbearances are off, then what kind of NPAs they will be starting and what kind of capital the banks required to deal with that. All those things are very, very important. So in an earlier webinar that I participated in, and I think in every speech which Governor Shaktikantas has made after the pandemic set in, he has stressed on the need for banks to raise capital in advance. Because we do look at, there could be a fair increase in NPAs going forward. There will be, the restructuring has been facilitated subject to certain conditions, but still there could be stress in some part of the books of the banks. And we thought that, if you look at the financial stability report that was published last, that talked of a possible, the extreme situation, NPA being about 14%, if I'm right. And therefore, I thought that the bank should be pretty well prepared for, a situation of that kind. Having said that, I must say that both banks and RBI have acted pretty proactively so far. And so in a nutshell, the impact of COVID is already known to all. We know what it has been so far. We are only happy to hear that there are some green shoots appearing, that there are signs of recovery in some parts of the economy. But I think we must, be very cautious in looking at how things will pan out in future, and uncertainties kind of remain. So that's the way I see it. So importantly, if you say what should the banking system do, I think I would say be prepared.
Great. Sir, we would also like to understand what is your take on RBI's response in handling the crisis and the steps which are taken to address these issues in terms of liquidity, moratorium, rate cut, or even restructuring.
So if you ask me, I'll just use two phrases. One, very proactive, but prudentially cautious. So I think it's been the right mixture of proactive action were required. At the same time, it is, the general approach in such situations is to become imprudent, a lot of things. But I think the Reserve Bank has been very, very prudent in whatever relaxations it has given. And even if you look at the restructuring scheme that the Reserve Bank has announced, it is very, there are very clear entry barriers. There are very clear-cut future requirements in terms of both eligibility and how should the scheme pan out. It created an expert committee under Mr. Kamath to tell what should be the broad contours of those restructuring scheme. So I think I did say in another newspaper that for me, what the Reserve Bank has done has been one proactive in terms of liquidity management. I think they have provided adequate liquidity to the system, but have been very prudentially cautious and have tried to avoid all the pitfalls of the earlier restructuring schemes like CDR, which allowed a lot of people who perhaps should not have been eligible to kind of take that benefit. So I think in terms of defining the eligibility, in terms of allowing things to happen, and in terms of actions taken in advance, both in terms of rate changes earlier and then in terms of liquidity management, I think Reserve Bank has been extremely proactive.
Great. Sir, what is your take on, as you already spoke about, the Kamath committee's, recent development which are coming. Do you think there should be some revisions or some more modifications coming in there? In your opinion, what is your take there?
My view when I was in the bank is that this must be very rigid. The conditions should be very rigid, and the whole objective of any framework should be that one, it facilitates people who have been impacted by COVID, but it does not the benefit of that does not go to people who were defaulting even before COVID. So I think it's for me, if you ask me personally, it's a very important precondition that one, those who are affected by COVID are given the benefit, provided they were not in default when the COVID was not there. So I think if you ask me in terms of eligibility criteria, the Reserve Bank has got it perfectly right, number one. Number two, it's very important to set the contours. I mentioned it earlier too. It is very important to set the contours right, because otherwise it is possible that the restructuring scheme could push the can down. See, the past schemes like CDR have facilitated pushing the can down. But I think this scheme kind of ensures that it goes to the right people and in the right manner. So I see everybody would want it to be as liberal as possible. But it's what is very important that it goes to the people who need it, and it goes to the people who need it in a manner that it requires to go. So I think if you ask me personally, it's a pretty well drawn out scheme. And the ideas which even Mr. Kamath has given in the committee report in terms of various ratios that they have prescribed, I think it's excellent. So I wouldn't want. I mean, there will be a lot of temptations. Everybody will say, "Why don't you include me? Why should you not be more liberal than this?" Right. I think as a prudential regulator, I think what Reserve Bank has done is right.
So this brings me to asking you this important question. Being the regulators there or being the supreme authority, so what are the key challenges being faced by RBI, especially during the pandemic?
So I think in terms of as a regulator, it's very important for the Reserve Bank to assess the situation, make regulations that are conducive to proper banking development during this period, but at the same time, it is not getting into a binge of regulatory relaxations. Right. So I think getting that mix right, one cannot say I won't do anything, but at the same time, the Reserve Bank cannot kind of open up things too much that all the problems get covered today, but will come up as a big mountain later. So I think that is the first thing that Reserve Bank had to do. The second is, of course, there's in terms of supervision, I believe that if you're not able to physically go to the bank, okay, so a lot of information gathering, off-site surveillance becomes a lot more important. Number 3, I think there are so many things that the Reserve Bank is to caution the banks about. And again, the Reserve Bank has played a very, very proactive role in terms of highlighting what are the issues. And as I said, even in my initial remarks, the governor has taken every occasion that he has had to highlight the need to raise capital. In fact, I must also add here that somebody asked me whether the fact that the governor is asking for capital to be raised, RBI is asking capital to be raised, does that mean that the Reserve Bank knows a few things that the public is not? So I want to begin, I think I've said that and I'm bringing it back here, which is that I think the Reserve Bank knows very clearly that in the case of a banking system, the difference between solvency and liquidity is very thin. Liquidity and solvency. So very soon a liquidity problem can get into a solvency problem, and a small solvency issue can drive the liquidity off. And therefore, I think the Reserve Bank has put a premium, and rightly so, on banks being adequately solvent, so that if there are shocks that will emerge after some of these relaxations go off, moratorium goes off, the restructuring happens, but still some of the restructured do not pay up. Some of the accounts that are not eligible to be restructured, they become bad. So there are a lot of buffers required. So the RBI has been highlighting the need for the banks to build adequate capital. And I think in terms of, one of the other areas which RBI has highlighted, and rightly again, is on BCP. And nobody had thought of working from home as the norm. And most of the operations of banks, where people were required, had to be done from back end or from their through their systems. So business continuity plans in such kind of eventuality is also very important, I think, and that's something the Reserve Bank has highlighted. So if you ask me, a lot of lessons, a lot of issues that the banks had to be told about, and RBI has kind of hit the right buttons, if I may say so, in highlighting them.
Right. Sir, before I ask you what could be the best lessons here, I also want to understand, since you have great expertise in terms of banking, also NBFC, cooperative banks, and everywhere, even foreign exchange market. I want to understand, from the eyes of different prospects, how do you see the challenges, boiling up there? From the eyes of banks, what do you think banks have been facing, or what issues or what challenges the pandemic has brought specifically for the banks and also for the government here?
So I think for the banks, two parts. Number one is that the delinquencies would have gone up. Many people, particularly the retail borrowers, many of them who have lost jobs or who have lost their regular income, the MSMEs, the kind of possible delinquencies there was a major challenge that they would have had. So the first thing RBI did was to give them moratorium. But moratorium, what does a moratorium do is impact liquidity, because whatever repayments are supposed to come wouldn't come, and therefore the impact of a moratorium is that the banks will not have liquidity, because as I said, in their typical asset liability management, repayments are an important flow that won't happen. Okay, so I think that is where the Reserve Bank has ensured that there's adequate liquidity in the system. Number two. Third, as I said, the banks have to learn to work in a situation of this kind in future. So we have had, if you look at shocks after shocks after shocks every 10 years, one thing or the other that has not been anticipated. So I was telling again in another context that when you do an appraisal today, in the past, you do a sensitivity analysis. Okay, sensitivity analysis says what would happen if the exchange rate goes like this, if the raw material prices go up like this, there's labor prices go up like this, there's an import tariff coming somewhere. So many issues are analyzed in terms of what will happen to the repayment capacity of a borrower. Nobody would have thought of a pandemic-related non-payment. So I think if you ask me, the sensitivity analysis that a bank would have to do, or any lender will have to do in terms of appraising the future repayment capacity of a borrower, this becomes a crisis, an unanticipated crisis becomes an important element. So the shocks that you subject borrowers' cash flows to have to kind of go beyond the traditional thought processes in terms of understanding where this problem will arise. Okay, so if you ask me lessons of that kind, then as I said, keeping the business continuity on course is very important. How they will be able to work, without people being there. And for me, an important, this is something I saw many of the other central banks across the world doing, is that there were a lot of, because there will be more payments happening, digital payments happening, digital transactions happening. There were scopes for a lot more of frauds, through these channels happening. So I think highlighting this has been something that the Reserve Bank has also done, and therefore having very robust IT systems to prevent fraudulent transactions, and customer education again to say that they do not fall prey to such players who might cheat them off. All these are so if you see some dimensions of what this pandemic has dimensions of issues that this pandemic has led us to, unlimited. So I think, but what is important is, obviously we couldn't anticipate this, but now only one line I can say is that as a banker, as a lender, as a financial sector player, you must anticipate the unanticipatable.
Correct.
That is the way I put it.
Yeah. Sir, we have already heard all the challenges, even the unpredictability of this unpredictable event which happened. We would also like to understand from you, maybe in one quote, as you mentioned this last amazing line, maybe you can give us one more proverb here, that what would be that one small thing which you would like to address, to avoid such pandemics, or to avoid having that much of an impact from such unpredictable situations coming up. What would be the lesson we need to learn, or what would be something? For example, I think digitalization has been the most important lesson being learned for all the businesses, for all the financial houses, for everybody, you and me and everybody around us. This digitalization is something which we need to learn every now and then. Cleanliness is something which we need to have always around us. So what is that thing which the financial institutions, the regulators, the bankers have also learned from this whole impact of pandemic?
So I think if you ask me, two important lessons I see. Number one is that there is too much of unpredictability in the world. Okay, some of them are man-made. I mean, some of those unpredictability man-made. If you look at the 2007 crisis, it is man-made. It is not nature. Okay, but it is man-made. It is there. Similarly, I think there are crises that might not be man-made, but for me, the only foil against, for a financial sector player, I think the only foil against such issues is to be financially strong. See, you need to have digital payments. You must have digital transmissions, transactions. All those things are fine. Okay, but I think for me, all these are possible only when the entity is solvent.
Right.
And by definition, a financial sector player is an extremely leveraged entity. So even if you go by, say, for a bank, to say go by the Basel standard, okay, you have the CRAR of 8% and all that. But technically speaking, on an overall balance sheet, a bank can be leveraged 33 times of its capital. That's the leverage ratio which Basel Committee has put in place. Okay, so by definition, and because that is required, you cannot, if a bank has to be very, very extremely capitalized, then the cost of services will be very high. Okay, so what I'm saying is that getting adequately capitalized is a very, very important requirement for financial institutions in general and banks in particular. More because they work on highly leveraged balance sheet themselves, and at the same time, as I said earlier, the dividing line between liquidity and solvency is very, very very, very thin, particularly for a banking institution. The other thing which I think the lessons for even authorities, if I may say, is that one has to become ready to be unconventional. Conventional wisdom would not suffice because there are challenges that keep coming of this kind. So ready to be unconventional, take a path of the normal, beaten track, ready to be doing that, while at the same time not to throw prudence to the wind. So there is the whole regulation of finance that is called prudential regulation. So it's very important to be prudent while at the same time being ready to be unconventional. So that's something that this has taught the banking sector or financial regulator. And obviously, the impact you asked on the government, again, that is very visible. There will be lower revenues. There will be call for higher expenditure, and obviously how to balance or how to raise the resources, how to balance the fisc is an important lesson that government has to deal. So obviously they have the responsibility for ensuring that the economy does well. The socially or economically weaker sections are adequately protected, and that means more expenditure. At the same time, revenues will be down. So I think how the government balances these two situations, again a lesson one learns, and therefore I think it's very important. In general, the principle is be prudent. Overall, be prudent. So because there is a rainy day likely, important to save. So whether it is for an individual, whether it's for a bank, whether it's a public authority, I think all of them will have to be ready to do that. But very importantly, willingness to think differently. I think, and that is, I must say here, not because I can I can say difference now that I'm outside of RBI, but I believe in terms of the thought process. I've said this very many times. The leadership in RBI has shown the willingness to, do the right thing, even if it is unconventional. Without, I am a prudential regulatory hawk. So I think in terms of, keeping the prudential framework in place, the Reserve Bank has not, let that sting off while allowing banks to do what they require to do.
So before we let you go, one last question would be for closing this session. Sir, we have seen that the economy, even before the lockdown, has been into a slowdown. So we would like to understand, in your opinion, how do you see that, RBI can take more steps or some measures which can be taken to, face or revive this slowdown of the economy?
See, I think there are limitations to what a monetary authority can do to, on economic side. There are, and obviously it can cut rates, it can provide liquidity, okay. But I think the economic development is a function of many factors, and at the time when inflation was, on the lower trajectory, the Reserve Bank, and in fact in some cases the Reserve Bank even kind of preemptively cut the rates. Okay, so and very importantly, I think the governor has been saying this, past governors have been saying this, is also transmission. So the RBI's policies are first is through the rate actions. It impacts the economy, number one. So it's important that the transmission of the rate actions take place. And if you ask me, I think the external benchmark system of rate interest rate determination is something that makes the interest rate more aligned with the rate changes that the central bank will make, number one. The second part is ensuring that the liquidity policy facilitates proper transmission. Okay. Third, I think is also an important issue is recognition of NPAs, resolving and recovery. And again, I think in terms of the framework that the Reserve Bank has put in place, in terms of what you call into the IBC, the June 7th circular, which is the secretarial circular, all those are actually actions in the direction of ensuring the delinquencies are identified quickly so that they don't kind of fester over a period of time. And then you have the IBC framework, which helps banks to recover the dues in a much more, much better system. So I think that is the other part that the regulator can do and has done. Lastly, I think, because RBI is it's a full-fledged central bank. It has also a developmental role. Lot of, for example, we have RBI has a role in rural credit dispensation. So if you see, it has expanded the priority sector lending. It has also now incentivized lending to the less banked centers in the form of, weighted priority sector credit for lending, opening a banking system. So we have the licensing on tap. Okay, so in terms of what a central bank can do, I think Reserve Bank has done. So you need some push to happen. I think we were watching the green shoots happening, and had it not been for the pandemic, maybe we wouldn't be where we are today. So it's in a way, it's a fact that we have to live with, and we can only wish for some of those positive high frequency data which are showing up and which are referred to by, I think, even in the latest Monetary Policy Committee minutes, which even Governor has written, which came out yesterday. I think all these, if they kind of sustain, we might see much better days much sooner than we are looking for.
Definitely. So thank you so much for your insights. It was an indeed pleasure to have you on this session and hear from you about all the insights happening, you being a central banker already. We hope to see you again with some more questions which we can, trouble you with somewhere. Thank you so much once again on behalf of Brickwork Ratings and on my own behalf. Thank you so much, sir.
Thank you, Ria, and it was a pleasure talking to you. Thanks for having me.